Okay, we are live. Hi, everybody. Happy Thursday, and welcome to another series of the Endowus webinars. Today, we have a very interesting webinar on one of our range of products called the Endowus Cash Smart solutions. And in an environment of higher for longer interest rates, we have actually made some enhancements and changes to 2 out of the 3 Cash Smart solutions that we have. Really pleased to finally do a webinar with Sin Ting again. It's been so long. Uh, so welcome everybody. I'm Sam, one of the co-founders of the business and the chief investment officer at Endowus, in charge of the investment solutions with a team of amazing, bright individuals who make up the investment office at Endowus. And Sin Ting is our chief client officer. Most people probably know you better than I do. They know me, Sin Ting, right? So say hi to everybody. It's been a while.
Thank you so much, everyone, for joining us today during our lunch hour.
Great. So we're going to kick off, guys, and we're going to go through it pretty quickly. So hopefully it'll be helpful for you because we just released the recommended portfolio change. That's what we call it. Endowus is always an advisory platform. So we empower individuals to make better choices. For the Cash Smart series, we're making enhancements and recommending a change to you, but it's your choice to take that recommendation. We feel that it is going to enhance the offering as a better risk-adjusted return product. But if you feel that it's not for you, or you want to actually change, opt out, or do other things on the platform, you have that flexibility always. So that's something that's really important to know. But I'm going to show, first of all, as a MAS regulated entity, financial institution, we do have to show our disclaimers, which is highlighted here, and also share with you the Slido. So we have a Slido ongoing, and if you can just type that in and pop in your questions. Also upvote the questions that you feel is going to be best for you. We also have below YouTube, please subscribe to the Endowus site, YouTube, so you can get updated on some of the amazing content that we have. We just finished our Endowus Wealth Tech Conference, our flagship conference, with a Saturday morning personal finance session that was attended by actually literally almost 500 people in person and a couple of thousand people virtually as well. So that was really good. But our YouTube channel has all of that content for free. So please go and take a look at that, and any new content will update you as well. But with that, I'm going to hand over to Sini to introduce us.
Thank you, Sam. I think, given where interest rates are today, it's even more important that we make our cash work harder for us. And I personally have my rainy day fund invested in our Cash Smart portfolios, as do many of our Endowus employees. So we're all, very excited about the upgrades in the portfolios that we're getting. So, for those of you who are newer to Endowus, our mission really is to empower all of us to invest better, to live better through conflict-free advice, institutional access, and low fare fees. If you just look at the logos at the bottom, these are our major shareholders, and Endowus employees still remain the largest shareholders in the company. We have some of the major financial institutions like UBS, Citi, MUFG, venture capital funds like Lightspeed, SoftBank Ventures, and government-related entities such as EDBI, and prominent Asian families invested in us as well. Go to the next slide. Just a little bit about our growth journey. We launched our product more broadly in 2019 when we became the first digital advisor for CPF. In 2022, we acquired a majority stake in a wealth manager called Carre Private, and now the Endowus Group is one of the largest independent wealth managers in Asia. We officially launched our Hong Kong platform in April this year. So if you have any Hong Kong friends who are, who might be interested in such a solution, please let them know as well. And I'm very, very proud to, tell everyone this, that, we have given over 40 million US back in cost savings to our clients in just trailer fee rebates. As of a couple months ago, we manage about 5 billion US across the group in client assets. And we recently did another round of fundraising for a total of 95 million that's been raised. If We go to the next slide. So our existing investors participated in this round as well, and we also brought on new investors in our cap table, including City Ventures and MUFG Innovation Partners. Next slide. So on our platform today, you can access some of the world's leading managers and often at the lowest cost. We offer institutional share classes of these funds, or we rebate the trailer fees back as cashback. So these logos are only some of the managers that are on our platform, and you can invest in these funds or even transfer your existing holdings of these funds to us and enjoy cashback on your trailer fees. Next slide. So we've designed Endowus as a goals-based platform where we want to help clients achieve their financial and life goals. So we believe that your different goals in life, whether it's saving for a rainy day fund or your kids' education or your retirement, for example, has different investment horizons and risk tolerances, and thus should be invested in different portfolios. So the cash management portfolios that we're talking about specifically today could potentially sit in the first two buckets for your cash flow needs in the shorter term, where you have lower risk and volatility as well. And now moving on, I'm going to pass it to Sam, who's going to talk about the new cash management portfolios on our platform.
Wonderful. Thank you, Sini. If I can just add 2 cents to here, I just want to highlight maybe this slide about the wonderful fund managers who produce the products that are distributed on our platform at the lowest cost possible. But there is, for accredited investors, a whole series of private markets, including private credit, private equity, alternatives, and hedge funds available on our platform. So if you are interested in those solutions, and these are like, globally best-in-class brands and products, Carlyle, KKR, Millennium, Point72, et cetera, et cetera. So please reach out to our client advisors at, what is the email again, Sini?
You can email us at support@endowus.com, and one of our client advisors will get back to you.
Absolutely. And then, what we're about is really not trying to create products or develop an algorithm that's going to beat the market. What we're about is really coming alongside you as a trusted advisor, figuring out what is your needs and your goals, and then, mapping that against what kind of level of risk we should be taking, and taking an appropriate risk that is commensurate with the returns that you're seeking to reach your goals. And that's the ultimate desire of all of this process, and investing, at all, is really to reach our life goals and our future financial goals. So that's what we're about. And the cash management solutions play a very important part. So today, we are making no changes to the Cash Smart Secure product. So that one at the bottom left is the Fullerton Cash Fund, and the Lion Global Enhanced Liquidity Fund is a 50-50 ratio. And combined is a very secure, safe, stable product that has continued to generate decent yields, especially in a rising interest rate environment. We've had to continue to revise up our yield estimations, and they've largely met the needs of our clients for secure, safe, low volatility or no volatility, and no risk of losing money. Virtually never ever lose money, and therefore that is the secure Cash Smart, more equivalent to money market funds. We have several money market funds that are different currencies, different types of money market funds and cash funds, and that we can utilize to manage our short-term liquidity where we cannot afford to lose money. But we have two other products in the Cash Smart series, and we call it a series because it's moving up the risk curve as we go from Cash Smart Secure, which is safe and doesn't lose you money, but gives you a certain yield. Enhanced is we're trying to enhance the yield by going a little bit further in the duration, the length of the investment horizon, beyond like a few, weeks or a few months, maybe even. And so we take a little bit of risk by adding from the Fullerton and Lion Global a product called United SGD Fund, which is a very short duration credit exposure that gives you a higher yield and gives you some yield, what we call yield pickup, in order to get a little bit higher return. And then there's something called ultra. And the reason it's ultra is not necessarily because it's ultra like safe. It's not ultra like high yield. It is higher yield than secure and enhanced, but we have to take additional risk in order to achieve that return. And we always say that return and risk always go together. We cannot take additional risk and not expect higher returns. But also, we cannot get higher returns without taking additional risk, right? So the risk, when we talk about risk here, is the risk of volatility of returns. So the returns can sometimes be up, sometimes down, but it's more volatile. And the more risk you take, the outcomes of the returns is going to be more volatile. Whereas cash smart secure is low risk or no risk, and therefore the volatility doesn't exist. It actually is a very stable, steady yield that you will generate. So I think just mapping out that secure, enhanced, ultra series is really important for us to grasp from the get-go. And why we're making these changes, we want to make it very seamless for individuals to map that risk map out. So from cash smart secure, the safest, to enhance to ultra. And beyond that, we have low volatility fixed income. We have the 100% fixed income products. We have the payout income products as well. So it's a mapping out of the risk spectrum that we're trying to do. In this specific case, what we're trying to do is make it more consistent. So that's the most important message I want to provide, is that this change in allocation is about trying to be more consistent in our asset allocation and our fund selection. So we didn't have Fullerton Cash Fund in the enhanced product or the ultra product because it was too safe, and too safe meant too low yield. But in an environment of higher for longer, Fullerton Cash Fund, despite being the most shortest duration of 30 to 60 days, is actually offering us decent yield. And therefore, we are happy to put that into the enhanced and ultra to allow that fund to provide a dampening of volatility, so that it becomes a little bit less risk, and yet we are able to generate the same or equally or better sometimes yield than what we had before. And so that's kind of the enhancement, as we call it, that we make into the cash smart solution. And as we do that, we obviously have to make room for these new positions, and therefore we're making a reduction in the equivalent product, which is the enhanced global liquidity, enhanced liquidity fund in the cash smart enhanced on the left side. And then for the ultra, we're taking a little bit off of all of those guys, adding both the Fullerton Cash Fund and the United SGD Fund, which has a great long-term track record, to make it a very consistent portfolio as we move along the risk curve. And the ultra, we're making way by reducing 3 of the existing short duration bond fund, and adding the SGD fund, but we are actually removing one fund, the Nikko Asset Management Shenton Income, because of a change in the way they're managing the fund, and which now makes it not a short duration bond fund. It actually becomes a long duration bond fund, and is ultimately not suitable for the Cash Smart series. The others are still pretty consistent in the way they manage duration, and all of them are short-term, short duration products. So again, we're de-risking, we're enhancing, we're making it a bit more consistent. This page will help you kind of, visually understand what we're trying to do. So the first 2 products is the Cash Smart Secure 50/50, least risky. Enhanced now includes both Fullerton Cash and Lion Global. And the Ultra, again, will have a corresponding smaller allocation as we build this in. From Security Enhanced, what we do is we add the United SGD Fund, which is what we had before, no change, 50% allocation. And then in the Ultra, we're adding the United SGD. So it becomes a gradual addition of risk. It's a gradual addition of duration. It's a gradual addition of pickup in yield so that we can target higher yield. And that's the most important word that I wanted to highlight also, is that it is a target yield. And there is consistency in the way we do that. For the secure, we've largely delivered that target yield. For enhanced and ultra, in different macro circumstances, in different interest rate environments, you're either going to get better than expected yield or target yield, And in certain circumstances, especially in the past like 12, 18 months where interest rates have gone up, you're actually going to have less than the target yield. And I'll go into a bit more detail later. So going to a bit more detail on the duration part and the yield. So you can see how we've mapped out across the spectrum, the most safest, the shortest duration at the top. So typically less than 3 months, sometimes even as short as 30 days or 40 days for Fullerton Cash Fund, Lion Global Enhanced Liquidity, the SGD and PIMCO low duration, and then Fullerton Beyond. And what happened to Nico is that they've actually changed their mandate from a short duration to an actually a longer duration. They're taking a risky bet that interest rates will fall faster and sooner. And yet, if you look at the yield, the latest net yield, net of the fees, management fees they charge, at the fund level, these are the net yields that each of these funds specifically are providing. And yet the Nico asset is not providing the yield that we feel justifies taking that additional duration risk, right? And oftentimes that also is aligned with the credit risk that often these managers are taking. And so additional risk should be compensated with additional returns or yield, and that's not happening. And we're very unhappy with that, and therefore we're taking Nico asset out of our portfolio. But the reason why we don't, let's say, for example, PIMCO duration, why don't we put all our money in PIMCO low duration? It's got 7% yield. The whole point is that low PIMCO US low duration has a lot of exposure to the US, a certain geography. It has exposure to certain segments or subsectors like muni bonds, for example, as an example. And also it has, as a result, a lot more volatility because it's a concentrated portfolio in certain subsectors and certain geographies, whereas other portfolios may be more diversified. And therefore, what we're building for Cash Smart, and it's okay, perfectly fine for you to buy a single fund or a single money market fund or a single Fullerton Cash Fund. That's okay. If that's what you want, that's not a problem at all. You can do that on FundSmart and do it at the lowest cost achievable here in Singapore on the Endowus platform, and you can manage it flexibly. But the reason why we built these Cash Smart solutions is so that investors can have convenience of having an optimized portfolio of secure, enhanced, and ultra that is optimized and pre-selected with what we feel is the best-in-class funds. And it allows for the most important thing in risk-adjusted returns, which is diversification. We want you to be diversified across multi-manager, different fund managers, not just all Fullerton stuff, or some other guys have only all Lion Global stuff or only PIMCO stuff. We want the flexibility that Endowus platform provides, which is we're multi-manager. We work with over 80 fund managers to provide you with the best products and underlying funds that are the building blocks to building the most optimized and best portfolio. So that's what we're about, and that's what the Cash Smart solutions are about. So it's an off-the-rack, one-click access to a Endowus Investment Office optimized Cash Smart solution that is very secure, enhanced, and ultra, and beyond. That will be easy for you to use. But any point in time you feel that this product is right for you, you can select a single fund from the FundSmart category. Now, the markets have been volatile. And as a result, the performance and the returns have been volatile. As I mentioned, Cash Smart Secure, and I'll show you a chart later and how that's done, it's been a very consistent performer. But obviously, Cash Smart Enhanced, which takes a little bit of duration risk, takes a little bit more credit risk, is going to be volatile during times of interest rate, volatility. Volatility meaning it's moving up or it's moving down. So when interest rates are falling, as it did in 2000, maybe back in 2019 or post-COVID in 2020, the performance was fantastic. It did great. But when the interest rates are rising, despite the fact that we are being compensated with higher yield, we're still going to have capital losses that is going to impact the short-term performance of these products. And therefore, if you look at the change that we're making, which is comparing the old versus the new RPC, pre-IPC RPC, recommended portfolio change, and post-recommended portfolio change. The historical max drawdown, although it was a bit more volatile, went up a bit more, fell a little bit more, or fell about the same in a percentage term, but dollar value would have fallen a little bit more from the peak because we're at a higher point. And then the recovery since have been largely the same. So enhanced is a marginal tweak because obviously we're only changing from Lion Global Enhanced Liquidity and allocating some to Fullerton Cash, and they have very similar characteristics, as we've said, is not a meaningful difference. But I think the Cash Smart Ultra is an example of how we can improve risk-adjusted return. So we're reducing the overall volatility of the portfolio. But we should not look at the historical performance so much, because the historical performance is swayed by the macro environment we're in. So what we put in didn't do as well, because the Fullerton Cash Fund was only giving you 1%, 2%, let's say 2% back then. And so putting that into the old portfolio means that obviously we're going to have lower returns. Obviously that's going to dampen the volatility, and it looks great. But what we're doing is actually looking forward and trying to enhance the portfolio so that we can actually get the same or maybe even better yields with taking less risk. And that's why I want to focus on how that ultra portfolio did after bottoming out towards the end of 2020, and how we've seen that rebound, and how the new and the old have performed differently. So the old and new have largely been in line, despite the fact that we're actually taking meaningfully less risk. And actually the new portfolio, because it didn't go up as much and fell less, is actually above the previous peak, as opposed to the old, which is now actually still below the peak, but almost there. And if we look at the yield as well, that is generating, and net yield is just an indicator, right? So how we calculate it, just to remind everybody's memory, is we use the yield to maturity of the bonds or the underlying money market funds or CD, certificate of deposits, or whatever it is, deposits. We take the blended average of that is provided by the fund manager, and then we blended average that in the Cash Smart solution. And then we take out all the management fees that goes to the fund manager for managing these money market funds and enhanced liquidity funds, etc. So this is the net gross yield. And I think this is also this is before we reflect the cashback from trailer fees, and it's before the Endowus fee. So it is kind of a gross yield, but it's net of the management underlying fee of the underlying fund. And so we can see that the enhanced, as I explained in the chart prior, very similar. Cash Smart Ultra, it was much lower at the bottom, but because of the yield pickup we've seen in it, especially the Fullerton Cash Smart, is commensurate to the old portfolio without giving up yield, even though it's a much less risky and less volatile product. And then on duration, it's the same thing. I think the enhanced is now narrowing to an almost similar duration. It's been falling because even though you reduce the duration, you can still get enough yield on the short end of the interest rate curve. And therefore, the duration is very similar, and we're getting the same yield pickup. On the duration of the Ultra, though, very, very different. And largely because, as I mentioned, we've taken out Nico asset, which has gone from 2-3 years of duration to, I think, latest numbers is almost 6 or beyond 7 years of duration, which is even higher than many of the global bond funds, which is typically considered to be long duration. So massive de-risking and not taking duration risk. We're barely above 1 year. We're around 1 year in duration for even the Ultra product, and we're able to achieve a similar level of yield. And so we have this slide, and it's going to be on the website. It'll be shared with you in the RPC, so I won't go into it in more detail, but just so that you know that the sequencing, right? Secure, the safest, the lowest risk, lowest return potential as well, because the yield is going to be lower. But secure is also giving you 4%, types of yield, and therefore it's good enough for you. But if you feel that you want to take a little bit of risk with enhanced and a bit more risk with ultra, and take on some duration risk and credit risk as well, then we're happy for you to take on that risk, knowing that it is possible that it is volatile, and also that it is going to be going up more when interest rates fall and falling more when interest rates are rising. So if you feel interest rates are peaking and interest rates are falling next year, then you might want to take a bit more duration. But whether you take that through ultra or through income or low volatility fixed income, or just 100% allocation to a globally diversified flagship fixed income, is largely up to you. It's the level of risk that you're comfortable with in achieving the goal that you're going after. And so just the historical performance, the reality of what the portfolios have done is, again, exactly what it was designed to do, which is that secure is very stable. There's a different gradation of the curve. So when interest rates are low, it's a slower pickup. And then when interest rates keep rising, the yields continue to rise and continue to go up. And therefore, the secure has been a steady, consistent performer. But during 2020 to 2021, when interest rates were falling or remained low, the enhanced and ultra obviously did much better. It went up more, faster, and it's seen as more volatile. But when interest rates started creeping up at the end of 2021 into 2022, throughout that cycle, you've actually seen them underperform and lose money for you as well. And the interesting thing, though, is that when it bottomed and what it's done since. So it bottomed in late 2020. So around October of 2020 is when both enhanced and ultra bottomed. Ultra obviously fell more, then enhanced, secure was safe. When it rebounded, and then in 2023, the second half most recently, we saw a sharp increase. Well, two things, sorry, I have to back up. First thing is that Fed continued to raise interest rates during this period, right? And yet it didn't fall, it went up. Second thing is, recently the market had a sharp backup in yield. So it went back up very sharply, the fastest rise in interest rates and market yield in a long time, and peaked at like above 5%. Why did this not fall like it did in 2022? The reason is because that the yields on these products are now compensating for the duration risk that you're taking. So for example, if you have a 1-year duration and the interest rates go up by 1%, then you lose 1% of performance, right? So duration and interest rates determine your capital gain or your capital loss. What happened here is that the interest rates moving from 4 to 5% means that you lost 1% if you have a duration in ultra of 1 year. For the enhanced, if you have a duration, as I showed you here, the duration was only 0.5%, then you lost 0.5%. But the yield on the enhanced now is above 4%, almost 5%. Ultra is going from 5% plus. And therefore, if you annualize it, you're still making 4% net and 3.5% net on the enhanced. And it's more than compensating for the risk of duration you have within the portfolio. So we needed interest rates to go up, because if interest rates are at 1% and you increase interest rates by 4%, you lost 4% on a 1% yield product. But it's the other way around now. You're actually losing 1% on a 5% product, so you're actually still saving and getting a 4% return. And this is why return and the yield projections differ. And this is a question that we get a lot. There is a gap between what is the projected return and the actual return, because it's not just the yield of the portfolio that determines your return. On top of it, you actually take on the duration and credit risk. In a good time where interest rates are falling, credit risk is not high, then you actually get a higher bump up. So the projected yield is, let's say 4, you might actually get 5 or 6 or 7. But when interest rates are falling and credit is deteriorating, then you actually lose out. So instead of getting the 4 as projected, you may get 3. And that goes down the curve. Ultra is where you're the most impacted with a 1-year duration. Enhanced is a 0.5 duration. And then secure is a virtually 30-day duration. And therefore, any movement in interest rate does not really affect, and you get the yield as it is most often than not. So I hope that helps to help you understand why there is a gap between performance and the yield, and why during 2020 to 2022, you actually had a better performance in these enhanced and ultra versus secure, and why that has reversed since then. But I think if you shorten this period to November, when the actual yields bottomed, at the end of October, most things bottomed, and then from 4th November is when all three bottomed as a portfolio. And you look at the performance since then, from November to October, so it's almost a 1-year performance. And actually, we've already come back to the normal state of affairs, where secure is actually giving you the lowest return, and enhanced is giving you a bit more return, and ultra is giving you an even higher return. And so you are being compensated in a higher for longer interest rate because the absolute level of the interest is high, and the incremental increase in the interest rate is not going to be more than the yield that we are being paid at the moment. So this is a very important aspect. And here, if you actually map this out to the next year, 2024, and where interest rates are likely to head, if you are thinking that interest rates are going to be higher for longer and flat, then there's no change in the interest rate. There's no change in the credit risk that you're taking or duration risk. Then you will actually get the target yield. If interest rates move from, let's say, this 4 or 5% range to, let's say, 7%, then you will actually lose on the ultra some money, but you will still get a positive return because interest rates will have moved up, and maybe you'll get 3%. But if interest rates fall next year, then what you'll get is the yield and then a pickup from the capital gain because interest rates are falling, and you'll actually get a bumper return on the enhanced and ultra. So we've gone through a very difficult period where interest rates have fallen. This is a chart that we showed you, but we're actually seeing a normalization of conditions, and this is why a lot of interest in cash smart products, yield products, are coming back. And if you are of the view that interest rates are falling, then taking duration and credit risk is actually something that you may want to do. But credit risk is something that is also going to be affected by the proposition that growth may slow, and we may see a recession, in which case companies may suffer in terms of cash flow, in terms of credit, in terms of maybe we see a rise in bankruptcies, and therefore credit risk may be a bigger risk next year in a growth slowdown environment than duration risk. So far, duration risk has been the bigger risk for us because interest rates has been the biggest mover, whereas credit, bankruptcies, and credit risk has been actually relatively muted. But if we go into a cycle next year where growth is slowing, we see a recession, and duration risk is not the risk that we're going to be focusing on. We're going to be focusing a lot more on the credit risk. So again, finally, on performance, what happens in environments where interest rates rise and fall? And we've shown this chart many times before, and what has happened. And we've seen that actually every cycle where interest rates are rising, COVID, the performance was a capital gain loss. And then when it rebounded, the pandemic will run, we had great returns. And then the up and down, we've seen consistency on how these various portfolios have performed. But the one that is really standout differentiated is the last drawdown. So the continued hikes in February 23 to now, during a period when actually interest rates had actually continued to go up, fixed income duration, because as I mentioned, it's not credit, it's duration. The 100% fixed income portfolio, the low vol fixed income portfolios actually fell, whereas the cash smart solutions, all three, since February of this year to now, have actually generated positive returns. But the order has been changed because the secure has generated the highest return, and ultra has had the lowest return. But that will reverse when interest rates move the other way. And this is just an example of the old portfolio, and the same consistent returns have been generated. So with that, I'm going to stop, and I'm going to hand over to Sin Ting to help us with the actual RPC, recommended portfolio change process.
Maybe just a really quick question, Sam, because
Yeah.
a lot of the questions on Slido is focusing on the differences between the projected returns and what the actual returns are, which you've just addressed. But there was a follow-up question on how does Endowus come up with these projected returns then?
So I think we have a slide here, right? I'll just flip through all of this and maybe go to appendix. We prepared a few slides. So first of all, using a projected yield and using these kind of yield to maturity as a projected yield return, not projected return, but projected yield, is a common industry practice. So it's not just us. Every other player, including FSM, Fund Supermart, iFast, AutoSweep, and Cash Products, Philips, Poems, Grab, Tiger, everybody actually uses the same concept, which is that it's actually the yield. Because to be honest, guys, it's really difficult to use anything other than yield because that's the only consistent metric that is available because what we're investing is in fixed income products, whether it's money market, whether it's bonds or certificates of deposit. It's all fixed income products, and as a result, that's the number that is consistently we are able to pull from fund managers to share, and therefore that's the number that is being used. Now, how do we calculate the projected yield? Is we actually obviously start with the building blocks. So we have the two underlying funds of Fullerton and Lion Global Enhanced Liquidity. Every month, we actually receive the latest monthly yield from the fund managers. I think there was one question about why don't we publish weekly yields like Money Owl or somebody. And I don't think that it really helps because it doesn't move a lot every week, because the underlying holdings hopefully doesn't change a lot over a few weeks. It will change depending on the allocation, depending on the duration. But a monthly update we feel is more than sufficient because it's a guidance, right? And so we receive the monthly yields directly from the fund manager. So we get it from Fullerton, we get it from Lion Global, we get it from PIMCO, we get it from all the underlying fund managers. And then the yield to maturity is calculated based on the weights of the individual portfolios. In this case, simple, 50% Fullerton cash, which is generating, let's say, 4%. Lion Global is generating 5%. Then the average of that is 4.5%. From there, what's important for us is the actual yield you're likely to get um, after taking out all the cost. So the cost is there's multiple cost items. One is the management fee and the total expense ratio of the vehicle, the fund that you're using. And therefore, we take out the management fee at source. And then on top of that, we have a very small token fee of just 0.05% for Endowus, and we take that out, and then we show you what is the net yield of the yield to maturity. And as I said before, I think that we know that interest rate movements, rising interest rates and falling interest rates drive price. So the problem with bonds is that it's still a traded a security, and therefore the price fluctuates. So if you hold it from issue to maturity, then you get the same 100 par. But in a rising interest rate environment, prices fall. And in a falling interest rate environment, prices rise. And so through the whole cycle and to maturity, it should not affect your returns. But because fixed income managers trade it, and because fixed income managers actually are affected, the underlying bonds, sorry, are affected by interest rates, there is movement in the value of the share price. So, for example, in this case, this is a cash smart secure yield. The projected yield in September of 2022 was a 2.8% to 3.1% return. Now, at the end of 31st October on the right side, what was the actual 1 year return? The 1 year return for Cash Smart Secure after 1 year of, at the time, projecting a conservative range of 2.8 to 3.1, the actual return we delivered, the historical return, was actually the high end of that projection of 3.1%. So as of October 31st, end of the month, the 1 year return is exactly the same and within the range of the projected return. And this is Cash Smart Secure because you are not taking the duration risk, you're not taking the credit risk. It's a very short duration of just 30 to 60 days generally, and therefore you're not going to be affected by interest rate movements. And it's institutional bank deposits or money market funds, very safe things, government treasuries that are going to expire after a month or two, and therefore you're guaranteed to get your money back. So you're not taking credit return a risk, and therefore the projected yield actually was the same outcome. Unfortunately, when interest rates move, as I said, it's not the same for enhanced. So last year in September, we projected a 3.8 to 4.1% return. The actual return wasn't that far off. It was 3.3. But if you think about what interest rates have done since then, is that interest rates have moved up another 2 percentage points, and if you are a duration of 0.5, then you lost a 1 percentage point. And despite that, we were able to safeguard some of that and generate 3.3%. So you're exposed to duration risk. And then finally, the Cashmart Ultra, we projected a return of 4.5 to 4.8 at the time. And as of the end of October, we actually generated 4.1%. So the 1 year return is actually pretty similar although again duration and credit risk has suffered, and I think this is the new ones, right? So I think the existing ones obviously are going to be negatively affected more than this. Oh no, this is actually the old versus the yeah. So this is exactly how we calculate the returns, and obviously it is going to adjust. 2020 we had actually a 2.3 to 2.6% range ultra, and at the end of 2021, 1 year later, because interest rates fell, Cash Smart Ultra generated above the range that we estimated. The yield that we estimated at January 2020 was 2.3 to 2.6. The actual return was 2.9%. So, in an environment where interest rates are falling or stable, we will be able to generate the returns that we foresee. And oftentimes, we actually are conservative with our yield projections because we want to maintain a buffer. We don't want to oversell. So, while other guys are projecting maybe 2.9%, we would actually tone that down to 2.3 to 2.6. We also don't have a single number. You'll realize it's not 2.6, it's a range, because we want to let people know that this is not a fixed yield. There is a volatility of outcomes. For Cashmart Secure, it might be less volatile outcome and it's pretty consistent. Enhanced a little bit more volatile, and Ultra a lot more. But we want to tell you that it's a range of outcomes, and that's why we publish a 2.3 to 2.6%. Even though 2.6 is probably the likely outcome, we give you a range that is below that so that people and investors can be aware, and we feel it's a better way, it's a more transparent way, it's a better way to educate investors as well in the process on the volatility of outcomes that may exist in these cash market portfolios. So I think that's more than enough uh, and a lot of data. So I'm just going to hand back to Sini to go through the rest of the slides before we come back to answer any other questions we may have.
Thank you, Sam. So in terms of, actually how would you opt in for these new Cash Smart portfolios? So for those of you who are holding it, you should have received an email, or you will receive it in the next couple of hours. If you go to the next slide, Sam. And you log into your Endowus account, there are two ways that you could do it. You can either click on the notification icon on the top right, the bell, and then you can review the recommendation there. Or you can go click on the specific goal that you're looking to change the portfolio of. And on the top right, under Manage Goal, you can click View Recommended Changes. The next slide. Then you can look at our write-up of why we are making these change, what the actual changes in the funds and the allocations are. And then if you want to accept this change, then you can confirm it via OTP verification. So there's no deadline per se on accepting this recommended portfolio change. You can do it anytime. You can read through our insights articles. You can rewatch this webinar before deciding if you want to go ahead. But it'll always be available for you when you're ready. And you can also choose to remain in the old portfolio if you want to. On the next slide. Just wanted a few things to keep in mind if you accept the recommended portfolio change, is that what will happen is we will redeem the funds that are now underweight or removed in the portfolio. And then when that is completed, we will invest the proceeds into any new funds that have been added or any funds which now have a higher allocation. And while this is going on, we will also take the opportunity to rebalance your portfolio as closely as possible to the target asset allocation. So the entire process will take about 5 to 10 business days. It'll probably be closer to 5, but just to be conservative, about 5 to 10 to complete. And during this time, you can still continue to invest or redeem from the goal. You just cannot do a full redemption until the whole rebalancing has fully completed and settled. Next slide. I just wanted to, share with the audience here that, Cash Smart is not only just available for individual investors, but it's also available for corporates. So we help a lot of corporates such as, SMEs, startups, nonprofits, family offices manage their treasury and liquidity part of their portfolios as well. So the same funds that are available for your personal money, it's also available for corporates. And this is really important point for corporates, that the cash and investments are held separately in their own legal name with UBKN. So your funds are never commingled with Endowus or other entities. And we also have very competitive FX spreads if you need to do that on our platform. Next slide. For corporates, for example, it's also we also look at it in terms of what the asset and liabilities are and what their needs are. So some of the companies that we work with, we like to discuss with them on how you can segment their cash needs. So from their operating cash needs, the daily needs that you have for your expenses, your reserve cash, which maybe you may need in the next kind of 6 months or so for things like dividend payouts or stock repurchases, and your long-term strategic cash, which have a longer time horizon for cash that you probably don't need in the next 1 year or so. And based on your different cash needs, just like an individual investor, we can craft a more customized solution for your needs. Sorry, Sam.
Yeah.
Were you saying something?
Yeah, just before we go to the Q&A, I think it's a Q&A section, but it's not just corporates. I think we do a lot of work with charities as well, nonprofits. We are about to launch our 3rd year of Endowus Giving Machines, which is the vending machines for charities. This year is going to be our biggest year ever, 34 charities that we're working with for physical vending machines as well as virtual vending machines at MRTs, etc. Working with Giving.sg and the MVPC and City for Good. And so look out for that. And we do come alongside nonprofits and charities who kind of fall through the gap because they're not serviced very well by the commercial banks or the private banks, or it's too small to go to directly to fund managers. So Endowus offers this service not just for corporates, but startups, charities, and a lot of companies, endowments, schools, etc. as well. So please reach out. We'll move to Slido. So if you have any questions, please plug it in. Upvote the questions you're most interested in. And I think a lot of it is overlapping and we answered quite a bit of it. So maybe we can just answer a few and then move on. And then we'll leave this as well showing. So you can reach out to our MAS licensed client advisors and also have this experience session. Cindy, maybe you can just explain this before we do the questions. Or
Yeah, so we have a team of 11 client advisors, and every week we do an experience Endow session where we walk our clients through, how to use our platform, our latest investment solutions, and you can join this group session, or if you would like to speak to an individual advisor, you can also schedule some time to do that. I am just jumping onto our Slido now, and we have quite a few questions on interest rates, right? So maybe I will just combine them. But basically, if we think that rates will fall in the next year, how will that affect Cash Smart Secure? And how should we position our portfolio? Should we add duration to our investments?
Yeah, I think that's a pertinent question. It really is very difficult to forecast interest rates because interest rates are a response. It's a response to certain macro conditions. The first thing is inflation. The reason interest rates moved up so quickly is because inflation moved higher very quickly. And a lot of people thought that it was temporary. Oh, it's the Ukraine war, it's the supply chain disruptions, it's COVID, it's lockdowns, it's China. But what we figured out is actually there's a lot of structural headwinds, including demographics. People are aging, not enough people in the labor force, structural shifts in the cost of manufacturing that's moving away from certain countries into higher costs. US is moving back their manufacturing facilities, et cetera, and the cost of input has risen. So I think that inflation is a very important metric, and it has come down, but it's not come down to the level that the Fed or a lot of central banks across the globe is targeting, right? It's the second question is another whole question to ask whether that is the right thing to do, target an inflation rate that is backward looking and is as low as 2%. Why shouldn't it be 3%? That's a whole different question, but that's currently the target. And where inflation is headed, whether it continues to come down slowly, or whether it spikes back up. And there is a risk of that any point in time. If, for example, the Middle East war becomes a regional war and like it disrupts oil supplies, and then obviously oil is going to be an important input in inflationary numbers and inflationary expectations as well. So there's a lot of moving parts. The other thing is growth. The other big thing is the elephant in the room is growth. Growth has surprised on the upside, especially in the US. And where growth is headed is going to affect where interest rate policy is going to head. And so last year, for example, the year before, when the inflation was high and everybody said it was transitory, the Fed also was very complacent and they had to chase their own tail. The market moved first and the Fed chased them up. In the recent debacle, kind of, you know, rebound in interest rate yields and market yields, the Fed was actually more consistent in their messaging. The market thought we had already beaten inflation and had priced in started to price in a fall in interest rates going forward. And when the Fed continued to talk hawkish and inflation started like bottoming and not falling, continued to fall and rebounded a bit, the market was the one that this time had to readjust. And so the market yields crept up or shot up very quickly in a short period of time to adjust to the new reality that the Fed will be higher for longer. So forecasting interest rates is a very difficult business. Like PhDs and global economists from the leading banks have all gotten it wrong. The Fed, which is the central bank, the guys who actually determine what the interest rate, even they got it wrong. So, it's not something that we can willy-nilly say, hey, interest rates are going to fall next year. That's it. There's nothing baked in. There's nothing that is for sure. We don't know what interest rates will be because it's difficult to forecast the growth, the inflation, and everything else that is surrounding the macro environment. And so, first of all, we need some humility to say that, hey, we don't know what the interest rates are doing, but let's play out some scenarios. Let's say, what if interest rates go up even more from here? Jamie Dimon from JP Morgan is famous, and I mentioned this at the Endowus Wealth Tech conference when I was talking with the Deputy Prime Minister Heng Swee Keat. We were saying that actually Jamie has been very bearish. He thinks interest rates are going to go to 7%. And then there's the base case, which is that, hey, interest rates are maybe not going to move any higher, and the Fed has put their interest rates on hold, and therefore maybe at least for the next 6-9 months, interest rates are not changing. And then there's a scenario where in the second half of next year, if you look at the Fed dot plot, interest rates are going to start falling. That's what they predict. They may get it wrong, but that's what they're predicting. The market thinks that the Fed is right, and therefore this time they're aligned. For the first time in this cycle, market was ahead, Fed followed, and then the market got it wrong, and the Fed was, and then they had to adjust. And for the first time, they actually have the same view that interest rates are going to remain high, maybe not rise meaningfully from here, and then start falling in the second half of next year because people are worried about growth. In that scenario, what happens? Two things. One, interest rates remain high, doesn't move as much, which means that you will get your yield. For the next 6 months, what our projected yield is going to be is probably likely the return that you'll be able to generate. When interest rates start falling, then you'll actually get capital gains, and therefore you want to take duration risk to get, if you want to take that risk, you don't have to. You're still going to secure, is still going to give you 4%, right? It's still going to give you maybe even closer to 5% for US dollar money market funds, etc. So you don't have to take additional risk and get compensated with decent yield. But when it falls, the yields will come down. Every month, it will adjust slowly, but it will start coming down, especially for secure. And you'll have to take risk on enhanced and ultra to enhance the yield that you're able to generate. And that's an environment which is a great environment for not just cash smart solutions, but fixed income. So that's why a lot of people are these days calling for fixed income. But you have to understand that they said the exact same thing last year. They said interest rates are peaking. We have to go into fixed income. And look what happened. We've actually lost money again this year. But in the last 2 months, we may see a rebound and we may not end the year in negative territory for fixed income. We may continue to be like a 2-year loss and then a rebound. And next year may position ourselves to be a great year for fixed income returns. But again, there is a risk that Jamie Dimon and some of the bears are right. So we have to understand and be cognizant of the risk that is out there, that there is no certainty when you're investing. There is volatility, but we can make educated guesses about what the outlook is like. And based on scenarios in this environment, this is what will happen. And therefore, this is the kind of portfolio that we should hold. But over the long term, it shouldn't matter to you. You should have the appropriate risk portfolio, not just for Cash Smart, but your core portfolio of fixed income equities that will give you the long-term returns and compensate you for the risk you're taking over the long term, which will always move to the mean average through cycles.
So
Hope
there's a
that answers the
question.
question. Yeah.
There's a question on recurring investments on RSP. So I'll take that one. Whether these cash management portfolios are suitable for RSP, like contributing a fixed amount on a monthly basis. So yes, you can definitely do that. So we can do recurring investments for cash management or other portfolios. You can contribute an amount starting from $100 each month. But whether it's suitable or not, I think really depends on what the purpose of this is for. So if you're trying to set aside part of your salary, your income every month into your rainy day fund or cash management needs, then yes, that makes total sense. I think if you're trying to dollar cost average into a cash smart secure portfolio, for example, then that may not make as much sense. So I think it really depends on kind of what your purpose is here.
Yeah. I think the whole point of recurring investment is to really help you with your behavior, right? First of all, our income is on a monthly basis. So every time our wage comes in, setting aside a certain portion of that,
Mhm.
saving it is great. Okay, that's not a problem. And you can choose what to invest in, whether it's cash smart or investments, equities, or high octane, private credit fund that gives you 10% or private equity or whatever it is. That's fine to set aside a certain portion of your money on a regular basis. Recurring investment, though, is a concept that I think is most useful and used most frequently in equities investing, because equities is a long-term permanent capital. You're investing for the long term, right? It's the longest horizon investment. Secondly, it gives you higher returns because over the long term, equity markets are giving you 7 to 10%, higher than fixed income at 3, 4% or 5% in certain cycles, and cash, which is giving you 2% or whatever it is. There is a gradation of risk that you're taking. Equities gives you the highest return because it is the highest risk, and risk is defined in volatility of return. So some years it's up 20%, some as it was 2 years ago. Last year it was down 20%. This year is up 10%. So the volatility of returns is what makes it more risky. But the longer you invest, the returns gravitate towards that 7-10% average return. And so does monthly saving do for you? You're investing it regardless what the market is doing, whether it's up or down. You continue to invest. And if you invest in that way, the moment you invested that month, the long-term return is going to average even out at the 7-10%. And that's why it's great form of investing for individuals, because then we don't have to worry about returns. We don't care what the market does this year or next year. We're not excited because we got 30% this year. We're not really devastated because it was down 20%, because over the long term, if we keep dollar cost averaging and investing on a monthly basis, the outcome is going to be consistent, right? Even though the market is inconsistent and our investment is inconsistent, the outcome is going to be consistent. And so that's what we're really working towards. And that's what recurring monthly investment is, such a powerful behavioral tool that we can utilize to improve our outcomes. What else? I think we're coming up on the hour.
I think
Is there
we've
anything? I think we
addressed,
answered most of it.
yeah,
Yep.
I think we've addressed
And
most of it.
guys, please, yeah.
So I think we're about to say the same thing, but if you have any other questions, obviously our team is here to help. So you can always write into support@endowus.com and we'll be more than happy to address any questions or concerns you have.
And if you missed any part of it, you can watch it again on YouTube. We will publish a follow-on article with some of these details that as we do in our Insights article. So we'll share with that. And you can always reach out and talk to our advisors or message us as well. With that, shall we say thank you and goodbye?
Yes. Thank you, everybody,
Wonderful.
for spending your lunch hour with us. And thank you, Sam.
Okay. Take care. Bye, everybody.
Bye.